Welcome back. Futures are mixed this morning. Stocks finished down yesterday across the board, and this morning we are looking at that continuing. Dow Industrials down 29, the S&P down 2.25. The Nasdaq is higher. It is up about 3.25 after a big sell-off yesterday. Markets down about 1%. Joining me right now, Horizon Investments Chief Investment Officer Scott Ladner. Scott, great to see you. Thanks so much for being here. We're waiting on the PPI number that's coming out at the end of the week, and of course, ahead of the Federal Reserve's meeting next week. What are your thoughts on what drives markets going into year-end?
Hey, Maria, thanks for having me, and good to see you again. Look, coming into year-end, the trade that has been working for the last month probably is going to end up still working through the next few weeks, and that trade is driven largely on positioning. So what we know about large asset managers and hedge funds, and frankly the retail public as well, is that people aren't very invested in this market right now, and so it hasn't taken a whole lot to drive prices higher. We think that dynamic changes though as we head into the next year. When we do see some pretty significant growth headwinds, and growth headwinds means earnings headwinds. And so, as we come into next year, we think we need to remain somewhat cautious. But probably the path of least resistance for the remainder of this year is higher.
Yeah, but I mean, it's all about the Fed, right? And about whether or not we're seeing an ease up in inflation. We've got the November Producer Price Index out on Friday. And right now, the expectations call for a gain of 0.2% month over month and 7.2% year over year. We've got the December Federal Reserve meeting next week, where we are expecting the central bank to raise rates about 0.5%, 50 basis points. Are you in step? Do you agree with all of that? And do you think this is priced into the market, or will this be a market mover this Friday?
Well, look, it certainly has a potential to be a market mover. I mean, the thing that really matters right now, is still inflation. I mean, the labor market backdrop is important. But inflation is really the thing that the Fed cares about right now, and the dynamics kind of generating that. And so, Friday's PPI report we do think is going to come in a little bit softer. We've seen softer inflation prints out of China. That does tend to feed in through the United States eventually. And so, we do think the top is in for inflation on a month-over-month basis. But that's really for goods inflation. The next sort of hurdle on the inflation fight for the Fed is going to be wage inflation, because that really drives the services part of the equation. And so wage inflation is going to be, really determined on supply and demand of labor. And right now we've got too little supply of labor. Participation rates are too low, and labor demand, frankly, is still too robust. Companies are not firing folks yet. The Fed can't really say this, but the Fed really needs companies to start firing people. They need some slack in the labor market to bring wages down. So that's really the fight that we think we're in for the first part of next year, but we're just not quite there yet.
Yeah, and the Wall Street Journal this morning reports layoffs coming at PepsiCo, that the company is going to be cutting out of its beverage unit. I'm with Mark Tepper this morning. Mark, jump in.
Good morning, Scott. So, look, I 100% agree with you that the Fed needs to break the labor market in order to cool off wages. And that's something that they're not going to come straight out and tell you, because that's not going to win them a lot of friends. But I have a question. After reviewing your notes, one of the things you make mention of is that once the Fed stops hiking rates, which I think a lot of people are expecting that would be maybe summer of next year, that's no longer an ideal backdrop for value stocks, which have worked very well so far this year. In your opinion, do you think that once the Fed stops hiking rates, that means that growth is going to come back into favor?
Mark, we do. The backdrop for value has been really excellent in 2022. You've had high rates, which have brought multiples down, which have really hurt kind of long-term growth stocks quite a lot. You've had really, really strong nominal GDP growth. And so, value stocks excel in an environment where the U.S. is growing really fast. Now, partly why the U.S. is growing really fast is because we've had really high inflation. But earnings are a nominal variable; they're not a real variable. And so, the earnings streams for some of these value companies have been growing, as fast or more quickly than the underlying nominal GDP rate, which has been really, really strong this year. As you go into next year, though, next year is a very different story. It's fairly clear that we've got a consumer that, even though they're in objectively pretty good shape, they don't feel great. And so, we do see nominal GDP coming back down. That's not an ideal backdrop for value stocks.
All right, we will leave it there. Scott, great to get your insights. Thank you, sir.